Morning, Daniel.
Good morning, Dan. How are you?
Doing well. It's a beautiful, beautiful June day in March here in Colorado. I think we're just everything's on the up and up. We're really enjoying it.
No, I agree. I like when the trees are blooming and stuff, as long as my allergies don't kick up.
Well, it'll sneak up on you whether you like it or not.
So what are we talking about today?
Oh, it's my choice here. What we're talking about here? You know what? Let's talk about my favorite, least favorite topic. Is this time different? Welcome to the Science of Wealth, where we discuss the science behind financial planning and the art of learning and applying it.
Is this time different? Just one topic for the day, or?
No, I think we're just gonna play through that idea.
All right. Well, it's an interesting topic, if I do say so myself. I think it's one of the most common questions we get, and we spend a lot of time telling people, this time most likely isn't different, and also saying, hey, those are some of the most dangerous things we can convince ourselves of when we're investing for the long term. But I think it's also just like an interesting question and thought exercise to go through is like, what if this time is actually different? What if we just ignore all of history and maybe say, okay, well we're in the now. What if this time maybe things are a little worse or things are going to be a little different than before?
So we've talked about this in looser terms in previous podcasts, and I'll go to the most extreme version here, which is like the end times are coming version of things. If you genuinely believe the apocalypse is going to happen, and you think it's a 1% chance, a 5% chance, a 10% chance, a 50% chance, you would anticipate that belief, right? Because surely that is the end of the world, and your survival, the welfare of your family is going to depend on how well you prepare for that, would translate to a proportional amount of hedging. So let's say you're a 1% person. Maybe you have some freeze-dried food in your basement. If you're a 5% person, maybe you've invested in like a portable generator, right? So that's sort of the extreme version here. And I don't know that we see that same kind of discounting behavior translate into the more commonplace, is this the next great financial crash, but not the end times type event.
So you're saying like freeze-dried food generator sort of thing. So I'm thinking like almost like apocalyptic. Is that what you're like when people say that to you? Is that what they're kind of alluding to?
No, I mean, my point here is that like there is a client out there, and there's a type of person out there who does actually think that there's a non-zero chance that World War III is around the corner. But I'm saying when we talk about the idea of is this time different or this time isn't different, it's about just is the market right? Is the current downslide of the day or the next impending downslide of the market going to be the next big 2000-day style 60% off the top sort of crash? Or is it the next 5% dip, 10% correction, 20% bear market where like it'll sting, but it's kind of temporary and not so life-changing? So I'm just saying, I think, in the apocalypse crowd, there's a more direct observable discounting behavior where depending on how seriously they think the probability of that is, you see some behavior around that like survival hedging, but you don't tend to see it in the market. In the market, you tend to see more extreme do-nothing behaviors or 100% discounting behaviors where you're just like going to cash overnight sort of stuff.
And has your conversation around that changed at all when people say things like, oh, it's really hard to find a job with AI and it's going to disrupt a lot of industries? I'm very concerned about the market. I guess how are you approaching that conversation?
I mean, that's an example of sort of like the boogeyman of the day, right? And the same thing existed, even our industry. We'll look at financial planners here for a second. 10 years ago, robo-advisors were going to put us all out of business. 10 years before that, online trading, discount brokerages, it's so easy a baby could do it, type stuff was going to put us out of business. 10 years before that, it was the decoupling of commissions and the ability of firms and companies to go out there and trade or invest or manage money at different rates instead of this government fixed rate environment. So there's always these examples of like, surely this will disrupt things, and disruption happens all the time in many industries. That's not the question, right? There's not a lot of people digging ditches with shovels these days. But on the other side of that, right, the necessity of the business, the necessity of the industry, right, of whether it's finance, medicine, law, software engineering, like we still need thousands, if not millions of people to do these jobs. So, you may be in the microcosm where you're part of a department that gets replaced by AI, or you're part of a company that is negatively impacted because its product wasn't sufficiently differentiated in a world where AI could vibe code a similar product overnight. But that these again are sort of temporary shockwaves, and the market and the economy and the people in it are highly adaptable.
So what if I like phrase the question a different way? Because I think there's some people that ask that question, and what they're really getting at is more like United States based. Like, hey, the United States has been an economic superpower for as long as I've been alive. What if that as nobody stays on top forever, the United States is shifting toward not being the top dog anymore, and one of these days, the allocation I have in the United States is essentially worthless because as a country we are going to tank per se.
Well, and I think you look at something like hyperinflation as a really good way that could actually happen, right? You think about like the Argentinian dollar, where inflation there has been like 54% year over year for years and years now. There's the famous Zimbabwe thing where they have like $1 trillion bills because the money is essentially worthless. If the dollar is devalued, right, or to take Milton Friedman, right, the greatest way to create economic uncertainty is to debauch the currency. If you take something like the value of the dollar and really destroy that somehow, whether it's through economic mismanagement, monetary policy, or whatever could possibly cause it, that's a real situation where then your U.S. domestic investments are going to be in trouble, right? Like that's a realistic scenario that could happen. I think we look at history as a better guide here, though. So you think about like Japan going, through the 70s and 90s, strongest marketplace. And then they went through an enormous crash, and it has taken them decades to kind of pick back up on the market side. And the basic answer here is don't put all your eggs in one basket, right? We have a domestic concentration in the United States because, to your point, the United States has been the stock market economic powerhouse of the world. But on the other side of that, right, there are plenty of other countries, plenty of other economies, plenty of services and products and inventions being made in other parts of the world, and you want exposure to that. And that's not only because they could make you good returns potentially, but also because, to your question, if the U.S. market one day does go down, or the economy devalues, or the tides of history come in, then you just want to be able to say you had some money outside of that ecosystem.
Yeah, I mean, there's no denying the United States has been an extraordinary place to invest for as long as I've been alive. But if we were, building in a portfolio from scratch today, I don't think our recommendation would ever be to say, let's put it all in one country, right? It's hard to assume, that one country is going to stay on top forever. We want ownership in, international markets, emerging markets, not because we, distrust the U.S. You may, because the future doesn't always belong to one country or one region. So I think that's important as well. You go back to the history, and I want to try to poke at you a little bit here for a second. Is there ever a way when somebody asks this question, right? Like I think you'd agree when I say like we have clients who are very analytical, and you can say things with numbers and facts, and they will buy in and understand what you're saying. I think we can also agree we have a lot of clients who aren't, right? And you start saying the history, and it goes in one ear and out the other. And at the end of the conversation, they say, okay, Dan, that makes sense. Thank you. Right. But then a year later, 6 months later, when something else happens, you have the same conversation over. Is there a way to approach this conversation with somebody who has genuine concern without bringing up things that have happened in the past?
I think it's easier to help contextualize their own behavior to them. So I'll give the example here, right? So like, Daniel, do you remember where you were on March 3rd last year?
I can guess, but not like specifically off the top of my head. No.
Do you recall anything important happening at the time?
No, not particularly.
Okay. I mean, our market went down by 1.99% on that day. Right?
Oh, yes,
big,
of course.
Big market decline day. Do you recall why it went down?
Tariffs?
I mean, it's a healthy guess. What about October 20th in 2022?
Not off the top of my head, no.
No, 2.75% decline in a single day on the S&P. Anything stand out about October of 2022 to you?
Not off the top of my head. And for those listening, I had no prep for this, so I'm not an idiot.
What about September 13th, 2022?
No.
How about June 13th, 2022?
No, I think around all of this time I was interviewing for jobs. So
Sure.
I was busy doing that.
Sure. And now I'm going to be picking on you for timeline here, but let's say December 24th, 2018.
Maybe election stuff, but like I said, I think we're noticing a pattern here, which is, I don't know.
Sure. April 4th, 2025.
Tariff?
Sure. February 5th, 2018.
No.
March 9th, 12th, or 16th of 2020.
COVID?
Sure. Right. So what I just kind of rattled off here are the 10 worst days as measured by the S&P 500 in the last decade. And to your point, right, you were able to kind of say, like, hey, maybe tariff stuff, right, particularly in that early 2025 timeframe, COVID in the early 2020 timeframe, sure. But, I pick at you about 2022, we're not sure. I pick at you about 2018, we're not sure, right? And here's the trick. All of those events were things that made like headline news in the marketplace. So it was tariffs, it was in interest rates and inflation rates, it was pre-COVID, pre-interest rate rising, right? The idea that the Fed was going to start raising rates soon after they've been at essentially zero for almost a decade. We have another period in 2018. It was just that the VIX, the measure of volatility in the marketplace, spiked, kind of uncharacteristically. So these are the worst days in the market, right? And the question then becomes, okay, I ask you, Daniel, these were big, important events in the economy and the marketplace in the world at the time, and we only really remember what was going on or where we were for two of them. Essentially, we remember COVID was COVID. We remember, tariffs, which was just last year. But if I poke at you about something 3 years ago, not sure. I poke you about something 7 years ago, 8 years ago, not sure. And yet these, again, were things that at the time, as somebody who's been practicing as a financial planner and all that time, at least one client said, like, well, gosh, I saw that the markets are more volatile than they've ever been, in history yesterday or the day before. And the market kind of dipped on that. Like, should we be getting concerned? Should we be getting worried about that? Oh, gosh, the market's been going down all of Q4 in 2018. And now the day before Christmas, it dropped, more than it has all quarter. Gosh, is this the beginning of the next recession? Well, the markets went up almost 7% by New Year's that same year, where literally there's something called like a Santa Claus rally, and that happened that year. And when you zoom out and say, like, okay, you don't even remember where you were, what you were doing at those times. And I think most people, maybe somebody at home was taking the quiz and like going like, where was I at that time? But when we look at the results of the markets during that time, right, from that volatility event in the beginning of 2018 in February, markets up 148% since then. Since the Fed tightening concerns at the end of that year, markets up 179%. Since COVID, markets up 175%. Since the inflation stuff in 2022, whether it was June or September, up 67 to 75% since then. Since the bear market volatility stuff that happened in October of 2022, up 82%. Even since tariffs last year, we're up, whether we're looking at March or we're looking at April, we're up 29 to 12% since then. And so I know that you bring up this point and you ask the question, what if we have somebody who's not about data points? What if somebody's not about history? And so that's where I just ask the question, right? Like, what have you, Mr. or Mrs. Client, done during all these historic events? And the answer for most people is nothing. In fact, I don't even know what you're talking about. What's important about October of 2022? And that's the point I'm trying to make here is, look, if nobody told you to be worried about it, if you weren't watching that YouTube channel, listening to that podcast, reading that particular news article, you probably wouldn't know that there was any reason to be concerned. And so the question becomes, if somebody wasn't telling you to be worried, would you be worried? And the answer for almost everybody is, well, no. And then the question is, okay, if you wouldn't be worried, pretend you didn't read that article, watch that show, listen to that podcast. If no one told you to be worried then, would you be worried right now? No. So then why would we make decisions about our life savings, our family's financial well-being based on the predicate of this one article, this one interview, this one video we saw?
What's funny is I went on a ski trip recently, and I think there's like two types of people on ski lifts. There's the people that like to talk on ski lifts and the people that don't. I tend to be in the latter camp. I just find it like a time to be quiet and like be very meditative almost. But it was funny because I was on the lift and it's like a 6-person lift. I'm all the way on the right side. So I can hear the people all the way on the left, but I'm not engaged in the conversation. And I realized it was a financial planner or an investment manager talking to somebody he met on the lift, I believe. I don't know if he knew them or not. But someone essentially asked him this question. And it was weird because I, as a financial planner, I didn't butt in or anything, but they essentially said like, oh, like, what do you think about everything, right? And I think that maybe they just wanted his take or whatever. And his answer was essentially like 5 words. He's like, yeah, no, I wouldn't worry about it. But that was it. And it was kind of weird because like it kind of rubbed me the wrong way almost, because it almost didn't feel like he was really even like listening to them, if that makes sense. Even though like I understand the sentiment and like the logic and what he is saying, and I while I agree with it, I left like the lift feeling like, like that was a weird way to answer it. Like it kind of just seemed like he dismissed everything the person said, and like didn't make him feel like an idiot, but like if that's all he had to say, it kind of made me feel weird. Like, do you think in a professional setting, like he did anything wrong, or like he could have answered the question better, even if he still like comes to the same point?
I'll admit I'm kind of jealous of the dismissiveness. I wish I could bring myself to be so succinct. I don't disagree. I think it's a bit of a dismissive way to treat a person or answer their question, because it could be based on intellectual curiosity, and then maybe the dismissal is the right answer. But it could also be based on deep, genuine emotional fears or concerns. You know, what if you lost all your money back in 2008 and you're worried that you're going to lose all your money again? I'm always reminded of that Mark Twain thing. I couldn't write you a short letter, so I wrote you a long one. I find myself in that camp when people ask about this, right? And some of our clients listen to this and have had this conversation with me about the current war in Iran, energy price stuff. And I think I have to spend 3 to 5 minutes giving my answer every time, just because I can't think of a way to say it more shortly. But it all does just boil down to, it doesn't matter in the long run.
Yeah, I guess there's also, you probably have to gauge the person if it's asking for emotional reassurance, or if they're simply asking for just your take out of intellectual curiosity, right? I know my dad would ask for the latter, not because he's genuinely emotionally concerned, just because he likes hearing what I have to say on the thing. But I know that because I know my father, and I don't know if this person knew him or not. So honestly, kudos to him a little bit for being so short. But it did feel weird just from the outside, not knowing the context, because if he did know him and the person was looking for an emotional reassurance conversation, it felt like just a bad way to kind of phrase it, even if that is the answer you still get to at the end of the conversation, I feel like.
Yeah, and I think at the end of the day, if you know your audience, right? Maybe this guy knows this person and knows this person will take whatever he says in a sentence, and great, he saved his lovely meditative ski lift time for enjoying the meditation instead of talking about markets. But yeah, I'll be honest, as a financial planner, there's a lot of times where we spend a great deal of time doing what I'll call smart guy pontification, which is, I don't really know how to answer your question in a way specific to you, so I'm just going to word vomit a ton of smart stuff at you that relates to your question, relates to your problem. But at the end of the day, I would really love it if I could just say, trust me, bro.
Yep. All right. Well, in regard to trust, right? Financial news. There is an infinite amount of information, and I think a lot of people would benefit from having a finite amount of information that they know is relevant and actually worth digesting. But, there's a lot of information out there in regard to finances, right? There's blogs, there's the Wall Street Journal, there's Yahoo Finance, there's YouTube, there's TV, and I think it can be really difficult to understand what is reputable versus what is not, and also when you're in a bubble, meaning you consume everything you consume is actually detrimental or not productive, and realizing you're in a bubble. Does that make sense?
Yeah, I think it's an interesting thing. You can go back to the Big Short line for Michael Burry, or who played Michael Burry in that, Christian Bale, and somebody says the whole point of a bubble is you can't see that you're in it, and he's just that's dumb. That's not of course you can see it. All that to then say, I do kind of come back to my core answer, which is it doesn't, again, zoom out, it doesn't matter in the short term, but I understand the temptation to understand what's going on in the world, right? I spend probably 2-3 hours a day here at the office monitoring things, researching things, reading about things, trying to make sure I have a very thorough understanding of what's going on, because I have a fiduciary duty to our clients to make sure that if there's something important or relevant, that I'm responding to it, or at least taking it into account. But at the same time, there is that balance where you just look at it and say, what is adding to your life, right? I don't think anybody has laid on their deathbed and said, if only I watched more Jim Cramer. It's just an interesting phenomenon where you have to kind of look at it and say, what is this hypervigilance adding to your life? What value is it? Some people are just curious. Some people like to understand current events, economics, really, really follow it. But I think there's a temptation to get that in bite-sized elements. I don't know. I've never had a client come up to me and say, I read, Daniel Yergin's, masterpiece on the oil and gas industry, and because of that, I have some questions about the current events in the Strait of Hormuz. It's always, the news is telling me the Strait of Hormuz is in trouble, and that's affecting the gas price, and I don't like that I just paid $3.99 for a gallon. And I get that, right? Life is lived in a lot of bite sizes, but it's a question about the quality of the content you're consuming, and whether, that quantity that can come with those bite-sized snippets is actually doing you any favors.
I think we're kind of bleeding the two topics together right now, because the third topic I wanted to talk about was, to what extent do current events really matter for investors? But I want to focus, at least the first part of this, on just knowing if the financial news you're consuming is actually reliable,
Mhm.
right? So like, can we just talk about like the different mediums that in which people consume, right? Like even like the news, for example,
Mhm.
right?
I mean, the trick here is for what purpose? I think that's the key question here, right? If I want to know what's going on right now, the financial news is not a bad mechanism for that, if only because they are constantly trying to find the next story, right? What are we going to talk about? What are we going to share? What's going to get published on the front page of the Wall Street Journal? Like, that's not a bad medium for understanding stuff that's going on right now. The problem is it is all historical. None of it is forward looking. Sometimes you get like an op-ed or opinion piece, but reporters, journalists generally are supposed to be reporting things they can verify have occurred and reporting the comments or ideas of other parties. And so, if you want to understand what's going on right now, the Wall Street Journal's fine, right? There's no problem with that. I think the challenge then becomes that some people will do a lot of this reading of historical recent news and then try to use that to inform their forward-looking behaviors. And that's a terrible idea, right? That is driving while looking in the rearview mirror the whole time.
Okay, well, like you're a CFP, right? I'm an aspiring CFP. If you write a blog, like why should I read it? Like, is that a good use of my time if I'm like for financial news, quote unquote?
Well, first of all, we don't do a lot of news, as it were, right? We tend to do more topical stuff. So, if you read a blog like ours, it's for understanding. Hey, I don't really understand fee model stuff, but Dan has written this blog about fee model stuff. Interesting. Or I don't understand how financial advisors get paid or how they get into the business. Dan's written this stuff. Or I don't understand, the impact of local, electoral items. We're voting for these tax measures, these ballot measures. How is that going to affect me? Is that going to affect me? Right. And that's not even forward looking. It's just, hey, math, right? If more tax equals less income to you, sort of stuff. So no, I mean, you shouldn't read our blog to understand the future, right? But you could read it for informational purposes. The same reason why you might want to read a book on a subject, but maybe you don't want to read a 300-page treatise. You want to read a 2,000-word blog.
So you'd call that like financial information, I guess. Like
a financial education.
Okay, well, let's stay on that then instead of news, because I think news is kind of adjacent to current events. But like financial information, is that something that's worth people's time, or is it essentially like I have a financial planner and I don't have to worry about it, or like should people still be educated, informed, and have an idea of the pulse of the community and what's going on a broader scale?
I think there's three categories of this. I think there's a person who it likes to learn. And then in that case, sure, right? Consume financial education, etc. I think there's a person who's looking for a solution to a problem. So they're maybe more DIY oriented. So they're trying to find like a good article on Roth conversions or a good article on optimal pension claiming strategies or something. Sure, that's fine. I think you need to be a little bit cautious about what you are gaining there. The one I'm actually strangely the least supportive of is learning to increase, reading content to become more financially literate. Because there's a validation problem here, and we can talk about how you validate here in a second. But the validation problem is, the person is trying to become more financially literate does not have the requisite base skill set, right? They don't know whether their initial sources of content are right or wrong, true or false. And so you can run into a bias problem or cognitive dissonance problem where, let's say, two scenarios. Person A finds a well-qualified financial academics blog or articles or YouTube content and they consume it. And so they're learning from a well-trained, well-validated, reliable source of information. And then they bump into some false information and it sets off their cognitive dissonance and they go, okay, that's not the right type of content, or I think that's wrong because that contradicts what I learned in the first place.
What do you mean when you say cognitive dissonance?
Cognitive dissonance is a stress response in kind of cognitive psychology terms, where when somebody tells you something that contradicts your deeply held beliefs or your fundamental beliefs about something. So, fictional example here: you're religious. Somebody comes to you and tells you God isn't real. You're going to have a cognitive dissonance response to that because you deeply believe in the existence of God and the meaning that your particular faith brings to your life. So coming back to my example, then there's person B who goes about in the wrong order. They go to TikTok, they find some complete charlatans, know-nothings who are just spouting financial nonsense. But they don't know any better. So like, well, this person seems to be rich and drives a Lambo. They must know what they're talking about. And then they go find some nicely vetted, accurate stuff that says a lot of the tax advice or investment advice they were getting from this TikTok content was garbage. And they're going to be sitting there and be like, well, yeah, but Joey over here whose channel I watch every single, 3 times a day, is driving a Lambo. Is this professor driving a Lambo? Well, Joey must be right and the professor must be wrong. Like, no, you're misunderstanding or conflating the messenger with the message here, but you're having a cognitive dissonance thing where you've learned something false first, and then when you're presented with true information, you have this negative response. So that's where the validity and reliability of the sources becomes really important, and where I come back to this person who's trying to become financially literate. Without like a well-grounded, I went to like a college course. I took it from like a true professional in this field type of that, credentialism, and credentialism has plenty of problems with it. You can run into a problem where bad initial information contradicts good later information and leaves you more financially ignorant than you started.
So if that person is trying to become financially literate, doesn't have a degree in this, hasn't taken a course, what would you say is an appropriate course of action for them to actually become a little bit more literate?
I think number one, depending on your degree of investment and interest, you could always take a literal like collegiate class. That's a big investment, big effort. So I'm not super bullish on that one, but it's just the like, hey, if you go take a personal finance class from a college professor, chances are you're probably going to get some decent information there, just because there's standards and educational requirements and so on. I think the second place to look at is, okay, does the source, if I'm not going to go to college, does the source of this information make their living doing what they talk about versus just selling content, selling courses, selling coaches, whatever it is? Like there's 1,000,001 online, learn personal finance courses. They'll range anywhere from like $20 to like several $1,000s, secrets of the money, like Tony Robbins type stuff, and a whole range in between. And in that particular context, what I think really matters more is this person a financial content creator, where they make money based on generating attention for their content product, and then you buy their content product? Or is this person a professional who's sharing? So for example, in our world of financial planning, I think somebody like Cody Garrett does a great job of financial education content, because Cody is a CFP professional who works with clients and has worked with clients for years, right? And so when he creates this content, he's doing it from a professional foundation where he's done it for a living for years. He's passed certification exams to show that he is competent in the subject matter. He's now written like a book on tax planning. Like, I think his content is very strong, well researched and validated. And because he puts it out into his professional community all the time, he gets plenty of negative feedback when there's like a detail or a nuance he hasn't gotten right. And to his credit, he tends to adjust what he's saying from that feedback. So like that's a good quality example. For somebody in the investment world, somebody like a Ben Carlson, who is a investment specialist at a large wealth management firm who influences the investment of billions of dollars. Like, that person has very high stakes accountability about their market research and their opinions on investments. So that's where, even though they both produce lots of content in blogs, videos, podcasts, etc., right? These are two individuals who make a living at the thing they are then creating content for versus being content creators.
Would an example of a content creator, kind of going back to what you said earlier, be like a Mad Money, Jim Cramer sort of thing?
It can be. I think that's more like financial edutainment, right? It's more about being entertained and maybe you learn something along the way than it is about learning. I have greater skepticism for something like, and I'll give you like a good and a bad example. It's like Dave Ramsey, famous financial educator. I think Dave Ramsey's content on budgeting, on debt payoffs, on avoiding dumb financial products, those sorts of things tends to be pretty strong. But Dave Ramsey has said the same factually incorrect thing about how you should invest for like the last 30 years and has never once changed his answer. And it's like, dude, like, I'm sorry, there's just so much research that shows that your investment portfolio, a quarter this, a quarter that, is just not a good investment portfolio, and that the returns are not reliable, and the retirement income from it is not reliable. So it's something where I think there's some subject matter from a well-known source that's good, some subject matter that's bad. And the good news is I don't think Dave Ramsey has any like $5,000 secrets of the rich types courses. Like, everything they produce is like $20, $40, or is free through your church in a classroom setting, that sort of stuff. On the other hand, you have people who are in the business of trying to sell expensive courses, where a lot of their courses are structured in a, pay $10 for the first course, and then pay $50 for the next course, then pay, $500 for the course after that, and $1,000 for the course after that. And it's just this constant pipeline of always dangling the next big financial piece of knowledge just beyond your grasp that you have to pay to get to the next step. And it's just sort of I don't know that I'd call it. It's almost like a levels of being in a cult sort of thing. It's not quite culty, but it's this whole like you don't have all the secrets. You have to like check the boxes to get to the next level. And I don't know. It just feels very scammy by default. And when I've seen behind the curtains on some of those things, where I see like, oh, here's the secret content from level 6. It's like buy index funds.
Yeah.
So, I don't know. It doesn't do very well.
I'm waiting for somebody to write a book on the secrets of the rich.
Oh yeah, very very topical. I wonder when that might be coming out.
So you mentioned like, I think you said edutainment, like education, entertainment, right? Something like Mad Money. I think that's some people's mode of digesting like current events, right? And like, I think that's what I wanted to talk about next was like, do current events really matter? How much of a pulse should we be keeping on them? Unless you are like someone who does this for a living, right? But like for the average person out there, like what's the benefit of that? If they're watching something like Mad Money religiously and their excuse or their reason for doing so is, oh, well, I just want to keep a pulse on what's going on. It's a good way for me to understand, things going on and, with the Strait of Hormuz or other current events and just kind of keep a pulse on things that are pertinent to me as an individual living a life.
Yeah, I mean, I think it's fine to be well informed about current events and want to keep up on things, or watch some extra videos to really understand like why is the Strait of Hormuz so important versus just bad stuff's happening there. I think that's fine. I think the challenge I have for anybody who does that then is the same challenge I have to put to myself all the time. Right? Again, I said earlier I spend 2-3 hours a day keeping up on things that are going on right now. The trick is I don't do anything with that information. Almost never has a current event influenced how I'm investing clients' money, whether I want to buy something, sell something, rebalance, swap out a fund or position, right? It's developing a very thick skin to current events where it's okay to learn about it. It's okay to be aware of it, to track it. But the trick is, I come back to the thing I brought up earlier, right? If somebody didn't tell you to be worried, should you be worried? The same thing about being informed about current events, right? Like just because there's a war in the Middle East or just because a president, changed parties, in a different country, how significant does something need to be to cause you to take action? And my general recommendation here would be it should be incredibly important to cause you to take action. And it should be so incredibly important that you should probably have it be something very obvious in your general thesis or in your investment policy well before the thing ever happens, right? Like you're thinking about black swan events like a 2008 crash, World War III type stuff, where you're going, okay, like if that happened, here's what I would do if that happened. And then the probability that happens is so low that, it's not going to be something that just like came across your newsfeed one day that causes you to suddenly go all to cash in your investments or something like that.
I think I would agree with you that for the most part, there's really no one specific current event that would warrant us to make drastic changes. But, right, this is a healthy exercise you as a professional go through on a daily basis, right? Call it 2-3 hours. Eventually, there will be a change that is made. Do you think sometimes it's the accumulation of like a sequence of current events that would warrant you to make changes, right? Like an interest rate change, or over a year, you've been following something and that leads you to eventually make a change as opposed to like one specific event.
Yeah, I mean, I'll use your interest rates as a good example of this, right? Take from 2020 to the present. When we went into 2020, we had long-term bond holdings. And we just had that because interest rates were coming up a little bit, but we just wanted kind of higher rates of return from where yields were at the time. We had no prescience about COVID or anything that was going to happen. COVID happens, interest rates go to zero essentially. Our long-term bonds get a huge premium in value, 20-25%, almost overnight. Great. Well, then we just sat on them for the next 2 years. And then as we got into 2022, we said, okay, rates are still zero. They can't stay at zero forever. They're going to have to raise rates at some point. Let's go ahead and dial it down to short terms. Lo and behold, 2022, rates start creeping back up. Turns out that was a good move. And we stay at these low rates all the way until 2023. And then we start creeping back up into intermediate and longer term holdings. And today we're back to long-term holdings. Interest rates have come back down from the highs in 2022, 2023. Not a lot, but a little. And today, if you said, Dan, what do you think is the next big portfolio change you're going to make or move you're going to make? I'm going to be looking for an aggregation of signals that rates are not likely to decline at any point again in the near future, and or that there are some negative signals in job rates or in inflation rates or in any number of things that could lead us to believe that maybe the Fed will start raising rates again. which would then trigger me to say, okay, let's go ahead and start shortening up our duration in our bond portfolio again. These are multi-quarter, multi-year, really long-term events where again, there's plenty of news and signals every day that suggest you should maybe go one way or the other, but it's this slow aggregation of signals that suggest rates will come down, rates will go up, that lead me to then say, okay, I want to kind of glide between higher rates and lower rates and try to keep in mind the duration of the portfolio and how it's affected by those events. But for example, if you then say to me, well, Dan, what about tariffs last year? What about the war in Iran? What about Strait of Hormuz? What about oil and gas prices right now? What are you going to do on the equity side? None of those signals say anything to me about whether we should be getting heavier in tech or heavier in energy or reducing our exposure to utilities or anything else. None of those signals are even remotely strong enough for me to contemplate at the moment. And that's what I mean when I say zooming out, having this very high threshold for changes.
So you said you do like 2 to 3 hours a day, right? Reading the journal or whatever it is you have in your stack of information. If somebody comes to you and says, I do it myself, right? I have $3 million and I manage it on my own. Do you think they need to be doing the same amount of due diligence and just like understanding of what's going on?
I don't think there's enough context in your question to really answer that. Just because, I don't know if this person has their PhD in finance, if this person has spent the last 20 years growing their $3 million from a tiny, acorn of money versus they've saved most of that $3 million and their investments have been questionable. I think if you give me random Joe on the street, they should not be paying attention to any of that stuff. They probably shouldn't be managing their own money. That's just the honest truth. Most people don't know what they're doing. So I find that question difficult to answer through no fault of any individual listener's own, because I don't know if our hypothetical person here is going to benefit from that or if they're going to be hyper reactive to that. But all the average human being statistics would suggest that it's a bad idea for them.
Interesting. What if, a client or somebody else just says, hey, like, I don't have 2 to 3 hours, but, I want to keep a pulse and I have like 20 minutes. Are there specific things on a high level you'd say, well, okay, well, maybe check in on this every once in a while? Or even then, would you say, honestly, you're probably better off spending that 20 minutes doing something else at that point?
I'm still going to say spending the 20 minutes doing something else. That doesn't mean they shouldn't stay informed. Like, it's fine to have a news source you read, right? Go to the BBC and read the headlines every day. That's fine. I'm not saying that the optimal strategy is to bury your head in the sand. But when we start to interact with how we manage our life savings and fend for ourselves and provide for the welfare of our family, and the stuff I'm consuming on my cell phone when I am on my lunch break, I am immediately very skeptical of the positives of that.
I think that answered the question. I just have one more I'm more curious about, and I think it's an observation I've had, on a ski lift or wherever, right? Is like, do you think there's an amount of people who do this, right? Like the current event thing, and how it's going to impact, the market and this and that, just because they kind of feel they have this addiction to almost like feeling smart?
Yeah, I think that's certainly a possibility. I have one anecdote on this that I just treasure deeply because it's too perfect. As I still remember, before COVID shutdown happened, the market started to slide in late January and kind of slid through February. It didn't really fall out until March. But I went to a chamber event and was talking to somebody who I'd known through the chamber for 5-6 years at that point. And bear in mind, the market's already down close to 10% at this point. He's like, and he's just very casually sort of bragging. He's like, oh yeah, I sold everything in my 401k and my 403b and all this stuff, and went to cash on coincidentally the day before the decline started happening. And I just sort of like, oh, well, like, good timing on your part, congratulations. Because yeah, he's avoided a 5-10% decline at this point. Sure, you happen to have gotten lucky in time to the market. Fast forward a year or two later, this individual and their spouse come and they come and have a financial planning consult with us. And in the part of the consult, they tell me like, oh, we have no savings, no investments outside of like our default pension through work, which is not a 401k, not a 403b, not a thing with the direct investments. So in 2020, he lies to me and tells me that he has dodged the bullet on the market. And 2 years later, forgetting that he told me that at the time, he's telling me we have no savings investments except our pensions. All that to say, some people like to feel smart, and frankly, the world's just full of bullshitters. And it's one of the things where, as a financial professional, when somebody tells me they're the smartest person on earth, the next Warren Buffett, I say, sure you are, and I move on with my day. I cannot be bothered to actually validate or question whether any random individual is actually good at managing their money or not. My default assumption is no, because through now hundreds and hundreds of client engagements, the typical answer has been doing okay, could have done better. And that's just normal. You can say the same thing to me about a whole bunch of topics, right? Fitness, diet, reading habits, all of it. Doing fine, could be better is, I think, a very normal state for people to be in.
All right. Well, I think that wraps up what I got this week. I think that's a good one.
All right. Well, then, Daniel, having learned all this fun stuff about markets and current events during our conversation here, what else have you learned in the last week or two since you've been on the podcast?
We recently transitioned from quarterly meetings to periodic meetings, from 4 meetings a year to 3, right? At least in a scheduled cadence. And I don't think the majority of people have had an issue with it. I think it's something I've kind of thought about and learned when going through it is just because we're not meeting as much, quote unquote, doesn't mean the expectation isn't there that we're still doing the work in that time period. So the same amount of work still gets done, but I don't think people feel the need to actually meet as much. It sounds like a big shift if someone's like, wow, we don't meet 4 times a year anymore. Now we meet once or twice or 3 times. But I don't think the majority of people actually ever wanted to meet 4 times a year anyways. They have summers and kids are home from school and they go on vacations more and more. But there still is this underlying expectation that they're compensating us to continue doing that work. I don't think the reduction in meeting tempo means less work. It just means, less time in the office, but it does in no way, shape, or form mean we're not doing the work. And I think that's something that was interesting for me, because going from that shift, I thought there would be a lot of pushback around we're not going to see you as much, and there really hasn't been. And I think that's kind of interesting.
Yeah, I think it's also something where we invented our own problem here, which is we felt like we needed to see clients that much to get all the stuff done. But we do most of our work for clients when they're not in the office. So that's part of the mistake on our part. But it's also something just to remember that the industry norm is to see your client maybe once a year. And I say maybe because there are some firms that meet with somebody, get their money invested, and then don't call, don't write, don't ever talk to them ever again unless the client calls them. So it's something that I think of note for us to just consider here is there's an environment in which we sometimes invent our own solutions in search of a problem. It's not to say I think our clients didn't benefit from meeting us 4 times versus 3 times now, and maybe we'll have some clients who still skip a meeting once or twice a year, so we only see them once or twice a year. But I think all that to say, I think that at the end of the day, what people are engaging us for is the value we deliver, not necessarily the time they spend staring at me across the conference table.
Agreed.
The Science of Wealth is produced by My Wealth Planners, a registered investment advisor in Colorado. The theme song is This Is Your Time by Dan Phillips. The podcast is intended for educational purposes only and is not investment advice or any other form of advice. Not all material discussed on the podcast is appropriate for every individual in every circumstance, so you should consult with a certified financial planner, tax professional, or legal professional as appropriate before attempting to apply any of the subjects, strategies, or tactics discussed on the podcast.